The President of the United States nominated a new Federal Reserve Chairman at exactly the moment federal prosecutors opened a criminal investigation into the sitting Fed chair, while gold collapsed 10% in a single trading session and silver plummeted 20% before most investors had finished their morning coffee. Here is what they are not telling you. On Friday morning, gold fell from $5,500 per ounce to $5,136, $364 per ounce, erased in hours. Silver dropped from $120 to $103. $17 per ounce vanished, while headlines focused on a single name, Kevin Warsh. The financial media immediately declared the crash a rational response to hawkish monetary policy expectations. They called it a repricing of interest rate assumptions. They framed it as markets breathing easier now that a credible Fed chair would maintain institutional independence. But here is what experienced observers noticed. The crash happened against a backdrop of criminal subpoenas, congressional standoffs, and allegations that the Department of Justice is being weaponized against the central bank itself. The question is not simply why gold crashed. The question is what this moment reveals about the forces now competing for control of American monetary policy, and what it means for everyone holding hard assets in the months ahead. Welcome to Metals Crux. Now, before we continue, if you have been following markets long enough to remember when Federal Reserve independence was assumed rather than debated, not because of trends or algorithms, but because the analysis we conduct here requires examining what others prefer to leave unspoken. And while you are here, drop a comment below. Tell us where in the world you are watching from. New York, London, Hong Kong, Zurich. Because what is happening at the intersection of American politics and precious metals markets right now carries implications that extend far beyond any single border. Now, let us examine what actually happened. Kevin Warsh is not a random selection. He served as one of the youngest Federal Reserve governors in history from 2006 through 2011. He was in the room during the Great Financial Crisis. He came up through investment banking at Morgan Stanley. His reputation is hawkish. His approach is considered pragmatic. His pedigree, according to those who have worked with him, produces clear signals and few surprises. Markets interpreted his nomination as a commitment to maintaining the Federal Reserve's independence from political pressure. They interpreted it as a signal that interest rates would remain higher for longer. They interpreted it as a reason to sell gold and silver immediately. The logic is straightforward on the surface. Gold and silver are non-yielding assets. They produce no income, they pay no dividends, they generate no interest. When interest rates rise or remain elevated, yield-producing assets like bonds and cash become more attractive by comparison. Capital flows toward yield. Capital flows away from hard assets. Prices fall. This is the explanation being offered across financial media. It is technically accurate. It is also profoundly incomplete. Because the Warsh nomination did not occur in a vacuum. It occurred against a backdrop that most commentary is treating as separate when it is anything but. Earlier this month, federal prosecutors opened a criminal investigation into Jerome Powell, the current Federal Reserve Chairman. Grand jury subpoenas were issued. The investigation centers on Powell's June 2025 congressional testimony regarding a $2.5 billion renovation of the Federal Reserve as headquarters. The question being examined is whether his statements were misleading. Powell responded with an extraordinary public statement. He portrayed the investigation as retaliation. Retaliation for the Federal Reserve's refusal to bow to White House pressure to cut interest rates. He warned that using law enforcement against the central bank threatened its ability to set policy based on economic data rather than political demands. Consider what this means. The sitting chairman of the Federal Reserve publicly accused the executive branch of weaponizing criminal prosecution to punish monetary policy independence. This is not a policy disagreement. This is not a difference of economic philosophy. This is an allegation that the justice system itself is being deployed against the institution responsible for managing the world in its reserve currency. The reaction across Wall Street and global financial institutions was immediate. Central bankers from allied nations expressed concern. Executives warned the investigation could undermine confidence in the American financial system. Republican lawmakers, including Senator Thom Tillis of North Carolina, announced they would block future Federal Reserve nominations until the matter is resolved. On Friday, after the Warsh announcement, Tillis called him a qualified nominee with a deep understanding of monetary policy. Then he reiterated his position. He will oppose the confirmation of any Federal Reserve nominee, including for the position of chairman, until the Department of Justice inquiry into Chairman Powell is fully and transparently resolved. The new Fed chair cannot be confirmed while a sitting senator blocks the process. The current Fed chair is under criminal investigation that he himself calls political retaliation. And gold crashed 10% in a single session because markets believe monetary policy independence has been secured Do you see the contradiction? The surface narrative says investors sold gold because a hawkish, independent Fed chair will maintain institutional credibility and keep rates elevated. The deeper reality suggests the institution itself is under unprecedented political pressure. Its current leader is facing criminal prosecution. Its incoming leader faces a blocked confirmation. And the boundary between monetary policy and political control has never been more contested. Gold has served as a hedge against exactly this kind of institutional uncertainty for thousands of years. It has been the asset investors turn to when they lose confidence in the systems that govern paper currencies. It has been the refuge when central bank independence becomes questionable rather than assumed. And yet, gold crashed. This is where sophisticated analysis must separate from surface commentary. Markets are not always rational in the short term. They respond to headlines before they respond to implications. They price immediate expectations before they price structural risks. They sell first and ask questions later. The initial reaction to Warsh's nomination was mechanical. Hawkish Fed chair means higher rates. Higher rates mean lower gold. The algorithm's executed. The position's unwound. $364 per ounce disappeared from gold. $17 per ounce disappeared from silver. But what happens when the confirmation process stalls? What happens when the criminal investigation into Powell continues generating headlines? What happens when the global financial community watches the American central bank become entangled in political conflict that has no clear resolution? The very concerns that drove gold and silver to record highs over the past year have not disappeared. Inflation has not been conquered. Government debt continues expanding. The Federal Reserve's independence is not more secure today than it was last week. If anything, the investigation into Powell and the blocked confirmation of Warsh demonstrate that the institution is more politically exposed than at any point in modern history. Central banks around the world have been accumulating gold precisely because they recognize this dynamic. They have been diversifying away from dollar-denominated assets because they see the structural risks building beneath the surface of American monetary governance. They have been buying physical metal because they understand that political systems can become unstable in ways that paper promises cannot survive. Those buyers did not suddenly change their assessment on Friday morning. They did not conclude that Kevin Warsh's nomination eliminated the risks that drove their accumulation. They are watching. They are waiting. And they are likely viewing this crash as an opportunity rather than a verdict. For retail investors, the question is brutally simple. Do you believe the Friday crash represents the market correctly pricing a more stable monetary policy environment? Or do you believe it represents a short-term mechanical reaction to a headline that will be overwhelmed by the deeper structural forces that drove gold to $5,500 in the first place? The institutions buying gold for strategic reserves operate on timelines measured in decades. They do not panic when prices fall 10%. They accumulate. The traders who sold on Friday operate on timelines measured in hours. They react to headlines. They chase momentum in both directions. They create volatility that longer-term holders can exploit. Gold at $5,100 is not the end of a story. It is a chapter in a much longer narrative about institutional credibility, political pressure, monetary policy independence, and the assets that preserve value when systems come under stress. The crash was real. The losses were real. The pain for leveraged positions was real. But the forces that drove gold higher have not been resolved. They have been complicated. And complicated situations do not produce simple outcomes. What happens next depends on variables that Friday's trading did not settle. The investigation, the confirmation, the political battle for control of the Federal Reserve itself. The signal is not clear. The signal is contested. And in contested environments, those who understand the full picture hold advantages over those who only see the headlines.